Welcome to our series on mortgage and finance training. You know, before we talk about where we are and where we're going, I thought I'd give you a little history lesson as to where the industry is. So, if I take you back to the 1930s, home ownership in the United States was at an all-time low. Very, very few individuals actually owned a home at this time. And think about where the country was. The country was just in recovery mode from the Great Depression. The economy was at a very, very difficult time, and very, very few people could own homes. The major reason they couldn't own homes was the financing. In order to purchase a home, the down payments requirements were 50 to 60% down, and the loan terms were only 3 to 5 years, mostly interest only. So who could afford a home? Almost nobody could afford a home. So in order to expand home ownership in the country and to help get America back on its feet, the government established what is now known today as the Federal Housing Administration, or better known as FHA. The goal was to improve housing standards and to provide better alternatives of financing. So here's what they did. First thing they did is they went to the lenders and they said, hey, Mr. Banker, Mr. Lender, I'll tell you what we're going to do to encourage more home ownership. The first thing the government will do is we will insure you against a loan default. The buyers don't make the payment, we will insure payment on the loan. Second, what we're going to do is we're going to improve the loan terms. Instead of the terms being a 3 to 5 year loan, we're going to offer a 20-year loan. We're going to improve the down payments. Instead of down payments being 50 to 75% down, we're going to begin offering loans with as little as 20% down. But there's a hook to it. Here's the hook. The properties have to meet a certain criteria. The borrowers have to meet a certain credit criteria. And if they do, we will insure these loans and offer these favorable terms, and hopefully will spur more home ownership within the United States. Bam! What a great thing. I love it. Here's what they did next. They decided to take it even a step further. The government, or FHA, went to these lenders and said, here's what we're going to do next. Rather than just insuring these loans, the FHA will actually buy these loans. We're going to buy them. What a great thing this is for the bankers. This allowed the bankers to take that capital that they had tied up in loans and put it back out in the market and go get more loans to further expand home ownership. Well, in order for FHA to do this, they had to establish another arm. So what they established was the Federal National Mortgage Association, which is now known today as Fannie Mae. This is how Fannie Mae got established. So, as we entered the 1940s, to make home ownership more appealing to veterans that were coming out of the war, they established the VA. And what the VA did is said, hey, if you're a veteran, we're going to allow you some financial insurance by insuring your loan with 100% financing. Man, oh man, did this open up the door to home ownership. So you had all these veterans coming out of service, and they also had the GI Bill to help get America back on their feet. Suddenly more people could afford more homes. What a great thing. Well, along come the 1950s. This other dude comes along that you probably never heard of him. This guy, his name was Karl. This guy was a genius. He was a rock star. What Karl did, and very few people know about this, he was the inventor and the creator of PMI, or what we know today as mortgage insurance. So he said to the lender, he said, hey, look, rather than 20% down, I'll offer mortgage insurance to allow home buyers to buy a home for 5% down, 10% down, 15% down. Bam! This really opened up the door for home ownership across the United States. What a great thing. So, the late 50s and into the 60s, America was experiencing a wonderful housing boom. We were the baby boomer generation. Families were expanding, and home ownership was at an all-time high. Now comes along the late 1960s. Well, I got to tell you, the period from 1968 to 1970 was a busy year for the government as it related to mortgage financing. So what the government did is they broke Fannie Mae into two companies. That's right, two companies. The first was Fannie Mae, and the goal of Fannie Mae was to buy private loans, only the private loans. They set up a second company called Ginnie Mae. Ginnie Mae's sole purpose was to buy the government or government-insured back loans. So now you had Fannie Mae buying private loans, you had Ginnie Mae buying the government loans. So we're in the 1960s, the Vietnam War is going on. Home expansion, home ownership is expanding throughout the United States in a big way. What was happening was Fannie Mae was becoming a huge burden to the United States financially. So President Johnson came up with a brilliant idea. He said, hey, look, here's what we'll do. We will make Fannie Mae a public company and we'll take it off the balance sheet of the U.S. government. Smart idea. However, they were concerned that Fannie Mae would be so large that they would become a monopoly. So in order to prevent them from becoming a monopoly, they established a second company to compete with them. They called that company Freddie Mac. So now you had these two big giant companies that were going to buy private loans in the United States. So we got through the 70s, got through 80s, home ownership is expanding, along comes the 1990s. Well, the government decided we need to make home ownership even more affordable to a lot of low-income families. So they created what is now known today, or at that time, the subprime loan. And here's what the U.S. government said. They said, hey, Fannie Mae and Freddie Mac, you need to make a larger portion of your portfolio available to more low-income families. So the subprime loan created a whole new set of guidelines that were much easier for people to get a loan. Those guidelines were this. First was a no-doc loan. No documents required to get a loan. This was amazing. Secondly, they came out with what they call no income verification loans. You didn't even have to have your income verified. They introduced what they called stated income loans. What is a stated income loans? You're not going to believe this. You could literally just write down your income on a piece of paper, state your income, and you could qualify for a loan. The one that comes along next was a killer. I couldn't believe this. They call ninja loans. What is a ninja loan? No income, no job, no assets, and you could buy a house in this country. That's how out of control the mortgage industry got in the 1990s. So this went on throughout the 90s and into the early 2000s. Well, by the time 2008 rolled around, more than 50% of the loans in the United States were considered high-risk loans. And this became what we know as the big mortgage fallout of 2008 to 2013. The U.S. government had to step in and the taxpayers had to step in and literally had to bail out Fannie Mae and Freddie Mac to the tune of about $200 billion, in addition to a lot of other big financial conglomerates in the United States. So there you have the evolution. We went from very difficult financing to easier financing to even more easier financing. And here we are today. The pendulum has kind of swung back. As a result of this Great Recession in 2008 to 2013, the government brought back a lot of mortgage regulation. So if you haven't bought a house in the last 10 or 15 years, you might be surprised by the extra documentation and regulation that's involved in mortgage financing. So there you have it. There's your history on mortgage financing. We'll see you in the next video.